The process to deregulate petrol prices has begun. Energy Minister Gwede Mantashe published a notice for public comment yesterday. Now, the move will allow retailers to set their own prices up to a specific limit. Let's get some input from Reggie Sibiya, who's from the Fuel Retailers Association of South Africa. Thank you very much for your time this morning. Let's start with some of your reaction to the gazette that was published yesterday in creating the price cap for 93 octane.
Good morning, Rohiwa. Firstly, I think let's just emphasize that this is part of the agreed process. If you recall that the first intention for the government was to implement this in June of 2022. And then obviously we challenged the government in terms of following due process, that in terms of the regulations and the Petroleum Products Act, there needs to be a fair and reasonable amount of consultation process. And part of that consultation process, obviously, is having the Gazette issued to allow for a broader public commentary or public participation. So this is in line with what we expect for a fair process. Mm-hmm. And then, but obviously we haven't yet dealt with the merits and demerits of the regulation itself. And as you know, Rohiwa, for us, there are three things that the regulation or government should focus on in any intervention. The first one is around jobs. The second one is around SME development. And the third one is around transformation. And all of these three elements, are actually the outcomes of the government's national development plan. And I would like to maybe take some time to then unpack these three areas in relation to this pricing that is being proposed, if I may.
No, please go ahead.
Starting with the jobs. Now, firstly, we have only R1.33 per litre for OPEX margin, which is the expenses. And that is already under recovery. But the main important thing as well is that in this R1.33 only, 60% of that is for the employment costs. So if then the government is saying we must use that to actually compete amongst each other, certainly 60% of that is wages. So it means then that the first casualties will be jobs. This will happen, Rohiwa, even with the service being regulated. This narrative that says jobs are only protected because self-service is prohibited is a very narrow and very misleading narrative, because as we speak now, since COVID-19, with this service being prohibited, self-service being prohibited, we have already lost 4,000 jobs. And now when we have to then use part of the margin for wages to compete, we're just going to accelerate the issue of job losses. And that is a real fact. Mm-hmm. Coming to the SME development, we actually believe that it is the mandate of the government to protect the sustainability of businesses. And so if you look at this margin that we are now supposed to sacrifice, the question is then, how are the businesses going to survive? And we have learnings globally on this, Rohiwa. If you look in deregulated markets like UK and Germany, service stations now are run by what we call glorified managers, because entrepreneurs and investors in retailing decided that this deregulation was no longer worth it, so they disinvested out of the market, and all companies then brought in glorified managers, employed people to run the service station. Again, this is now against the National Development Plan, because the National Development Plan talks about developing and sustaining businesses and business owners, not glorified managers. So that is the second element, how this pricing mechanism talks against government policy. And thirdly is the issue of transformation. You know, again, this under recovering already OPEX margin of 133 cents does not even cover the loans, you know, that black retailers who are new in the industry needs to actually are obligated to actually honor. And they are really scratching the surface as we speak with this under recovery OPEX of 133 cents. And now to expect them to then go and compete, you are actually just taking them out of the system. And as a matter of fact, the DMRE is not doing justice to the public, because if you can look in the past 5 years, the number of black retailers that are exiting the industry is not a good picture. So instead of the government using regulations to protect these three very important elements of the National Development Plan, the government is the one that is facilitating the erosion of jobs, the erosion of SME, the erosion of transformation.
But then how do we then address the issues of the unsustainably high fuel prices, Mr. Sibiya, when we take into account those three important components that you've mentioned? We currently have the fuel levy relief that is at 75 cents at the moment, but obviously that's going to be coming to an end. And government is seeing this deregulation or form of deregulation as a more sustainable solution. But if it's got a negative impact on those components that you've just described to us, how do we then, or what do we create as a sustainable solution?
Romeo, sorry, let me just also add this element of unfair competition, then I'll come back to you. This also creates an unfair competition, and I'll tell you how. Because right now, the industry is faced with rampant illegal trading. Now, when I talk about illegal trading, is that you've got wholesalers now who are selling directly to the public, and that is not allowed. We also got people that are selling without the licenses. If you look at the energy white paper, the three milestones that were in there, the first one was say, let's rationalize the market and let's actually control in terms of who operates using these licenses. Now, this DMRE is failing dismally for the past 10 years to actually control. So now what is going to happen is that you're going to get these illegal traders who gets the product via sometimes, you know, not so kosher means of getting the product, and also who are not contributing towards taxes. So they get this product and they're not paying back the taxes. So that's how they're actually going to discount. And retailers are then going to forced to actually compete with these illegal traders, which is already happening, you know. So that, again, is creating unfair competition. Now, coming to your question is, then how do we deal with the situation? So the situation that needs to be addressed is the area of, well, what is our economic situation looking like in South Africa? Because one of the key components of the price going up is the rand-dollar exchange. How do we then strengthen the power of the rand? That is a bigger economic situation. You know, the issue of us importing the product is never going to go away.
Yes.
So then we then need to look at then how can the government assist. But having said that, Rowena, I mean, I've been saying to people right now, we are looking at this next coming price announcement at over 150 per litre decrease based on the current market trends. Again, you know, we have to be careful how we react to temporary situations like the geopolitical issues. But what has happened now is that because of the fears of recession, global recession, you know, rising interest rates, rising inflation, so that has also affected the consumption of fuel by consumers. And then that has actually now led to the decrease of prices. So let's then also observe that trend, because the estimation is that that trend is going to be with us for the next coming 6 months or so. So there is a relief already coming in terms of just the movements of the basic fuel price. And what people have also been saying, let's review the price structure. And I agree with that.
Yes.
But you have to follow the right process of reviewing. We want the price also to be reviewed but our belief right now is that the margins are under recovery. And we believe that if the price is reviewed properly, actually the margin should increase. So we are not against reviewing the price. In fact, if you look at one of our most under recoveries, which is the credit card costs, which are real costs that we actually incur on a day-to-day basis, they are not in the margin. And if you swipe a credit card right now, that costs you about 46 cents as a retailer in terms of merchant service fees. Now, we want the review of the margins and of the pricing structure. We want that. And because we know it's actually going to show, in fact, the 2016 review study that was done by KPMG in 2016, that review showed that the retail margin was under recovering by 12 cents a litre. And guess what? The department decided not to implement it because that review showed an under recovery. And that is not talking to sustainable SME development agenda by the government.
Many people are wondering, and this will be my final question to you, Mr. Sibiya, why is it something that is looked at for 93 octane and not both grades of fuel, 93 and 95 octane here, particularly because many South Africans, and you'll correct us if we're wrong here, do use 95 more than they would 93 octane petrol?
Well, the rational use is that 93 is only used in inland, which is actually, again, not a sound reason, and that on a national scale, then 93 is actually lower in volumes compared to 95. But if you look at inland market only, 93 is still very significant. And actually, your question, Rohiwa, if I may, reminds me of something, because DMRE has actually implemented maximum pricing on LP gas, right? Some years ago. And when they implement LP gas, I can tell you now LP gas is not cheaper. So what has LP gas done? The impact of LP gas is not going to be as significant as the 93 because LP gas was a small stock keeping unit in our businesses. It was not that big. But what they did before maximum pricing, retailers were making 40% gross profit on LP gas. I mean, if you look at the food market, they're making 60% gross profit margin. So then the department introduced the maximum pricing on LP gas, and they reduced that gross profit from 40% to 15%. And then what happened, Rowena, because LP gas is a byproduct of a fuel, the prices of LP gas have just escalated, if you look from 2020 to today, by 45%, just in line with fuel. But what has happened in that situation is that even the 15% that was given to the retailers, reduced from 40%, is no longer realized today, because what happens is that the BFP equivalent of LP gas keeps pushing up, and the wholesalers, they keep pushing up the price because the wholesale price is not kept. So wholesalers keep pushing up the price in line with the production cost.
Yes.
And that has actually squeezed out even the 15% on LP gas. That's why, as a result, some of the service stations actually stop selling LP gas because it's just no longer profitable to keep that part of the business. Now, that is because it's a small volume, so we did not see the impact. And DMRE was supposed to do an impact analysis study on these maximum prices, which they did on LP gas, and then analyze it and then realize whether they need to proceed it or not. And they have not done that. So with 93, it's going to be just chaos because it's going to affect jobs. It's going to affect transformation, as I've stated before.
Yeah, no, very interesting insights there, Mr. Sibiya. Thank you very much for your time. And of course, these are conversations we'll continue to have as government and related stakeholders look to find sustainable ways to keep the petrol price at somewhat of an affordable rate for the average motorist or South African in general. That is Mr. Reggie Sibiya from the Fuel Retailers Association here in South Africa.